Good evening, everybody, and I hope you've had a good weekend. You're ready for the weekend. But before I get you ready for the weekend, or you get ready for the weekend, I thought I'd share some tax tips with you because I've done quite a few lives talking about different property strategies and things you should bear in mind or think out about. But I haven't done one on tax for a while, and I had quite a few people asking me saying, "Can we have something on tax?" So I thought, why not for a Friday early evening? So I'm going to share a few tips with you. The first one, which is a common one and comes up a lot, and I think you should pay attention to it, especially if you have a portfolio where you own companies in your own name or in a partnership or through a limited liability partnership, which is also a partnership, or if you're looking to get into property and you're a high rate taxpayer, is think about whether incorporating your property portfolio is something that you should do. Now, there are some people out there who'll say incorporate every single portfolio, and I disagree with that. I think it's horses for courses, and it's about doing the numbers and looking at the impact and seeing, is it worth you incorporating? So, for example, somebody who earns, let's say, £30,000 and has two properties in their own name, it might not be worth them incorporating that particular portfolio, but it could be worth them buying future properties in a limited company. Because when you incorporate, you've got to remember there's a possibility you pay capital gains tax. There's a possibility you pay stamp duty land tax. You'll have to refinance, most likely. I know some people talk about doing a deed of trust. I'm not going to cover that today. And you've got the costs of the mortgage, legal costs. And then obviously, usually higher rates of interest through a limited company compared to owning property in your own name. Somebody says, "Hi, Shaz, happy Friday." Hi, sorry, you haven't got your name up there, so if you can type your name, that would be really good. But thank you for joining, and obviously feel free to ask any questions that you have. So look at those costs and then think about the savings. Now, of course, if you have a property business, then you could incorporate your property portfolio and not pay capital gains tax. But you've still got the issue of paying stamp duty land tax. So you need to consider the impact of that. Alongside that, if you have a partnership and it's an established partnership and it wasn't established just to benefit from incorporating and not paying SDLT, then you may not have to pay stamp duty land tax. So the general thing is, do the numbers, do the sums, see if it works for you, and if it's worth doing, then do it. I find a lot of people who approach me sometimes haven't thought about it in detail. They think they ought to incorporate just because somebody's told them that they've incorporated, and sometimes it doesn't work. And as an advisor, I'd say that doesn't quite work for you. Don't do it. So think about incorporation, but only do it if it works for you. The second one is make use of all your tax bands, and if you have a spouse, civil partner, husband, wife, then make use of all of their tax allowances as well. So, for example, let's say a husband and wife situation, and wife earns £70,000, husband earns £30,000, and they've got some property together. Then you want to, and they own it 50-50. Then you want to be thinking about how to give maybe 75, maybe 80% of the income to the husband, so you can use up his basic rate band of tax, and the wife gets less income, because obviously for the wife, she can't claim all her mortgage costs. She can only claim up to 20%, so she's paying more tax. The husband's a basic rate taxpayer, isn't affected by Section 24, and therefore why not use up their allowance? Alongside that, you've then got things like the personal savings allowance, the starting rate savings allowance, the marriage allowance. So thinking about those allowances and many others, by the way, and thinking about how you can make use of them. You then have your annual exemption for capital gains tax purposes. Again, think about how you can use those allowances. Then for inheritance tax, you have certain annual allowances in terms of giving things to your children and grandchildren. And if they're getting married, there's an allowance for that. Again, use those allowances. There's quite a few different allowances. I'm not going to run through every single one tonight, but the main point is become familiar with those allowances and use them, because in most cases, if there's an annual allowance that's available, if you don't use it, you lose it. So generally speaking, you can't carry it forward. There's one or two exceptions, but more often than not, you can't. So therefore, you want to make sure you use it the best you can. Another one which could work well is rent a room relief. So if you have somebody living in your home with you and you're renting a room to them, and you give them access to your kitchen, bathroom, and other parts of the house, then you can earn up to £7,500 tax free every single year. If it's a husband and wife situation, it's half of the 7.5, so 3,750 each. So why not use that? I mean, not everybody's going to be comfortable with having a lodger living in their home. Some people do it for different reasons. If you are, make use of that. Have a question from Emma. Hi, Emma. And the question is, I have heard that capital allowances on eco, e.g., photovoltaic, is changing from offsetting against tax to a check at 150%. Are you referring to, Emma, research and development tax credits, or something else? Because you need to be a bit more specific with that in terms of exactly which tax relief you're referring to for me to then be able to answer your question. Because there's a few things that qualify for 150%, and I'm not sure exactly what you're referring to. So if you can possibly post that, then I'll happily answer your question for you. Now, I mean, the 150% generally linked with capital allowances is the land remediation relief, which isn't a capital allowance per se, but that usually has where you can claim 150% of the cost if you pay to have contamination cleared, like Japanese knotweed, asbestos, other forms of contamination. So that's 150%. But and then there's obviously the R&D relief, which is 150%. But there's nothing specific about 150% for capital allowances on energy efficient or eco efficient items, Emma. The third one is knowing and making sure you claim all the different tax deductible and tax-free expenses. Now, I'm asked quite often, what can I claim for tax purposes? And the answer is anything and everything, so long as it's wholly and exclusively for the purpose of your business. So there's no limitation in terms of what you can't claim, generally speaking. It's got to be for the purpose of your business. And in terms of kind of tax-free allowances, there's quite a few different things. I'll run you through 3 or 4 very quickly. Some of these you may have heard of. So if your staff members can have an annual eye test payable by the company, and that's not a taxable event. Mileage claims. So if you claim mileage and the company doesn't own the car, the first 10,000 miles you can claim at 45 pence. Any subsequent mileage in the tax year is at 10,000 at 25 pence per mile. When you claim that, it's not a taxable event for you. Every year, you can have your team go for a party, and it's £150 tax-free. Usually people use it for a Christmas party, but it can be a summer barbecue, or it can be a party at any point in the year. It's tax-free. You've got something called trivial benefits, where you can give up to £50 or less to each team member, as long as it's not cash or a cash voucher, and it's not being paid in return for work or for them hitting their targets, and it's not part of their contractual obligation, and they can't exceed £300 in the year. So you can do 6 lots of 550, so 6 lots of £50 in the year, taking you up to £300. So those are some of the kind of tax-free benefits. There's quite a few other ones here I've got, by the way. I'm not going to run through every single one, but it's making sure you claim all your expenses. Quite often I come across people who haven't claimed all their expenses because they weren't aware of them. So be careful on that. Now, in terms of company cars, again, it's worth you doing a calculation. Are you better off claiming mileage? And usually the older the car, the better off you are claiming mileage. Are you better off having a sole trader or an unincorporated business or an LLP to run your car through that particular vehicle? Or are you better off running a car through a limited company because you've got an electric car or a hybrid car, and the tax rates are very low? And again, it's about doing the calculation and working out which scenario works best for you, and the more energy efficient it is, usually the better it is to, if you have a limited company, to get it through the company, because the government at the moment are incentivizing people to go electric. Therefore, the tax rates are pretty low. So make sure you take advantage of that, because that's very important. Now, something else that you ought to be aware of, if you're buying a property, and you'll have to pay stamp duty, land tax, depending on the value of the property. If you're buying 6 or more properties from the same person together, then you can use non-commercial rates of, non-residential rates of stamp duty, land tax. So work out if that works better for you. You can also claim multiple dwellings relief. Work out if that works better for you. So you do the calculation. Standard SDLT on all 6 properties. Am I better off paying non-residential rates? Am I better off using multiple dwellings relief? And then based on those 3, go with the one that works best for you. Now, in terms of multiple dwellings relief, it doesn't have to be 6 properties. It has to be 2 or more properties. So let's say you're buying 2 properties from a seller. One property is being sold for £600,000, the other one for £300,000. You can aggregate the value, i.e. work out the average. So 600 plus 300 gives you £900,000. Divided by 2, work out the SDLT on the £450,000 per property, times it by 2, and then work out what the SDLT is. Overall, you'll pay less stamp duty, land tax than you would do on a property worth 600 grand and then £300,000. So it's kind of working out that particular calculation to see which outcome gives you the lowest possible tax. There's nothing wrong with that. HMRC and the government give you the opportunity to do that as you choose. Now, we don't have any other questions. I don't want to bombard you with lots of tax tips. Just want to bring 3 or 4 things to your attention. If you have any questions on tax tips, or if you want me to do more stuff on a particular tax, feel free to email me or send me a question through Messenger, and I'll be more than happy to answer that for you. Have a wonderful weekend, and I shall see you next week. Bye for now.